Hello, and welcome to our webinar, Crypto and Counter-Terrorist Financing, a Critical Approach. I'm Michael Heller, Head of Financial Crime Compliance Proposition here at Dow Jones, and I'm here with Neil Samtani, CEO of VASPnet. Let's get started. Our first question, Neil, can you please share a little bit about your background and journey to becoming CEO of VASPnet?
Absolutely. Thanks for having me here, Mike. So my journey started in the early 2000s, where I was responsible for implementation of OTC derivative confirmation generation technologies. I did that for a number of years and moved to New York, where I was working for JP Chase, heading up a small team of within compliance technology. From there, I had the opportunity to move back to London and take on a role at HSBC, responsible for enterprise architecture within global banking and markets, specifically in the client onboarding and account maintenance space. Shortly after that, I moved over to HSBC Securities Services, where I was responsible for data provisioning technologies, which was very important for the visibility on how data permeates within a global organization such as HSBC. I was raised in Gibraltar, and I had the opportunity to return to join the Gibraltar Financial Services Commission, where I took on the role of heading up the implementation of MiFID II's transaction reporting. That was very important here in Gibraltar, but equally, I had the opportunity to be working alongside the DLT team. That was a team responsible for one of the world's first crypto regulatory regimes. While working alongside them, I saw how pioneering the work that they were doing was. And this was at a time that predates the inclusion by the Financial Action Task Force of VASPs into scope for the 40 recommendations. After implementation, a core group from within the DLT team left to form the consultancy X-Reg Consulting, which is a public policy and regulatory affairs consultancy specializing in crypto. And I had the opportunity to join them, and I did so. One of the interesting initiatives that we kicked off shortly after the consultancy was formed was the launching of the Joint Working Group for InterVASP Messaging Standards that set out to establish a universal industry standard language for data sharing between crypto businesses to comply with their regulatory obligations. It was designed to allow for compliance with the travel rule, which we'll get into more detail on shortly. What was abundantly clear through this journey was that even though VASPs, these crypto companies, could exchange data in a manner with which it could be received and interpreted as intended by the sending party, what wasn't clear was who you're sharing that data with. We'll talk later about the decentralized nature of crypto, but what was fundamental was understanding who your counterparty is. And that was, I think, the mission that VASPnet was launched with, to be the world's assured source of regulatory data on crypto companies, with the intention of helping firms meet their regulatory obligations more sustainably.
Excellent. And Neil, it's an honor to have you here as we kick off our expert webinar series. Moving on to the next question, as our audience has different levels of expertise, perhaps you can define some of the following terms we'll be using today, such as VASP, on-chain, off-chain.
Absolutely. I'll start with VASP. So VASP was a term coined by the Financial Action Task Force, FATF, in 2018 to bring crypto into scope for their recommendations. FATF, of course, the Financial Action Task Force, is a global standard-setting body for AML and CFT. So VASP is any natural or legal person offering for business reasons the services of exchanging either virtual asset to virtual asset or virtual asset to fiat, remittance or transfer services, safekeeping or administration of crypto assets, i.e. custody of assets, and providing services related to the issuance of virtual assets. So more generally, when we refer to a VASP, in Europe it's referred to as a CASP or a DASP, crypto asset service provider and digital asset service provider, respectively. What we refer to are crypto companies in the generic form. You mentioned on-chain. And when we refer to on-chain data, and we'll refer to that a couple of times over the course of this session, I'm sure, is transactional data. This is data that's held on the blockchain, which of course is this decentralized, distributed ledger that's digital and duplicated across nodes or computers around the world. We could see it as a settlement platform. Any transactions that are executed on the chain are essentially settled by way of this distributed ledger. Due to the nature of on-chain activities and the way that the blockchain works, these transactions are immutable. So we'd be able to look at the ledger and understand how much value is being held by any particular account that exists on the chain. And most of these distributed ledgers or blockchains are public. So it's available for anyone to query. However, when you look at that, when you look at the blockchain, you don't get names, you get addresses, a codified representation of an account. And finally, you mentioned off-chain as well. And when we refer to off-chain, we refer to one of two things. We could be talking about transactional data. That's any data that could have been completed by systems off the blockchain, but settled on-chain. For example, we might be referring to a settlement, a netting settlement type system, whereby transactions take place off-chain, but there's one settlement that takes place on-chain. And it could also refer to information pertaining to those industry participants that use the blockchain, i.e. the VASPs that we'd be referring to.
Thank you, Neil. And you noted earlier FATF's travel rule. Could you provide the audience with an overview of this guidance?
Absolutely. I have been living the travel rule for the last few years. It's my subject of expertise. Now, of course, in traditional payments, we think nothing about a wire transfer, much like a SWIFT payment that might take place between financial institutions that allows for both the settlement of a value, a payment taking place, but coupled with that, the sharing of information related to who the originator is in a transfer, in a payment, and who the beneficiary is. And that information would be shared by way of an MT message or an ISO 20022 type message that would allow for the receiving party, the beneficiary institution, to understand where the value has come from, where the payment has come from. And equally, the originating institution would be able to say that where the value is going, not just to, say, an anonymous numbered account, but to an individual's account. That's the reason why certain identifying information on who the originator and the beneficiary information would be shared. This has existed in the traditional finance space since FATF had included in the original 40 recommendations back in 1996, recommendation 16, which was the requirements for wire transfer or the travel rule. Now, what this does for traditional payments is it establishes a paper trail. And it allows for the institutions to undertake their regulatory obligations in determining whether or not a participant in this transfer is sanctioned or otherwise beyond the risk appetite of one of the institutions. So both institutions would be able to make a decision about whether they wish to reject the payment, take freezing action, or file a SAR. They could have follow-on action by way of having access to this information. So back in 2018, what the Financial Action Task Force did was try to introduce parity in the application of AML and CFT, including into scope for their recommendations, virtual assets and virtual asset service providers. So now we have a requirement that countries that had previously been compliant with FATF's recommendations had to either extend or implement new AML-CFT regulation to adhere to these recommendations as they applied to VASPs. So we have parity and consistency between VASPs and other financial institutions. So the travel rule that previously existed we should be able to lift and shift this to apply to VASPs. It should be easy. However, there are core structural differences that exist between traditional financial institutions and the infrastructure to which they work, and how we see crypto working. Crypto is inherently disintermediated. In other words, it was designed and conceived to be able to support and address being spun up by anyone. Imagine no intermediaries, which means no banks, a bank account with no bank. It would be under the sole control of the individual that spins up that particular address. Now, the features would allow for anyone that creates an address to operate and control that address themselves. This is referred to as a self-hosted wallet. And we know that whilst that was the intention, it wasn't necessarily the outcome. We know that there are centralized intermediaries that control assets on behalf of others. These are the VASPs. And one of the key decisions that has to take place when complying with the travel rule is that you have an institution, an obliged entity, would be required to determine whether there is a VASP at the other end of the transfer chain. The first thing they would do is say, is this value that's being sent, that's being transferred, going to a self-hosted wallet, or is it going to an intermediated or hosted wallet, whereby a VASP has control of that wallet? When there's a VASP at either end of the transfer chain, either at the originating side or the beneficiary side, that particular transfer, if it exceeds a de minimis threshold, would have to be compliant with the travel rule. It would be in scope of the travel rule. Now, what FATF guidance had clarified was that once establishing that the transfer is in excess of that threshold that might apply, the de minimis, as it was documented by FATF, was set to $1,000 or equivalent. However, in certain jurisdictions, including in the EU, there is no de minimis. Every transfer would be compliant if there's a VASP at either end of the transfer chain. And what the VASP would have to do to comply with the travel rule is first determine, is there a VASP at the other end of the transfer chain? Secondly, identify the VASP at the other end of the transfer chain. If the originating institution, being hypothetically Coinbase, is sending value to a beneficiary that's whose address is managed by, say, Binance, they would have to identify that it's Binance at the other end of the transfer chain, and then undertake an element of due diligence on that counterparty VASP. That's referred to counterparty VASP due diligence, and it's a key tenet in the travel rule in order to ensure that we understand that both institutions understand who they're doing business with.
With that comprehensive background, we're going to pivot to the intersection of virtual assets and terrorist financing. The Wall Street Journal reported on Monday that the U.S. levied a fifth round of sanctions against Hamas, a designated terrorist organization targeting currency exchanges as key funders for the group and citing cryptocurrency transfers. What does the travel rule mean for counter-terrorist financing?
Gosh, it's incredibly prevalent right now, and a very important subject. Much was made and headlines were formed based on some figures that had been presented on the amount of value that was reaching terrorist organizations by way of crypto. And one point that we have to acknowledge, I think it's clear, given that we're having this conversation today, is that it's known that Hamas and other terrorist organizations are leveraging various financial transfer mechanisms, including cryptocurrencies, to support their terrorist activities. So we have to consider this from the perspective of regional, international, and domestic financing. And it can include payments to facilitate crowdfunding, and it could include using the infrastructure afforded to them by way of cryptocurrencies and crypto assets to allow for the laundering of real-world assets and other forms of assets to crypto and then back into real assets. The figures that had originally been proposed, which were north of 150 million or so, there was an element of nuance there. When references have been made to a volume or value of total amounts that had been shared or distributed to terrorist organizations flowing through VASPs, the key term was connected to in the original text. And this was important because we shouldn't confuse the value that might be held with a VASP with the value that is then going to be dispersed to the terrorist organization. It's important that when undertaking any transfer, any VASP and any financial institution has to ensure that they understand their counterparty or their customers' AML and CFT controls to ensure that this can be mitigated. So whilst various figures were being proposed, some as low as $450,000, some much higher, it's important to also note that not all of it will have gone through directly for the purposes of crypto fundraising. Crypto laundering would probably have ended up pushing that figure much higher, because we know that the total value that will likely have gone through crypto laundering, i.e. using mechanisms related to the blockchain and cryptocurrencies to obfuscate the source of funds, would be significantly higher than that would have been raised by way of crypto fundraising. And the reason why I say that is because when it comes to crypto fundraising, there's an element of transparency that the blockchain affords the viewer. That means it's very difficult to obfuscate completely the source of funds. In other words, if a terrorist organization is to advertise an address, for example, and suggest that assets should be deposited to that address for the purposes of terrorist financing, as Gaza Now had done previously, what becomes clear is not only can you tell the address is one that's being used for crypto fundraising for the purposes of terrorist financing, but also you can identify the addresses that are sharing that value with that address. That address will then be subject to freezing actions if it's identified soon enough. And also you can see the outflows from that address. So that transparency is an inherent trait of crypto. It's for that reason that Gaza Now took a decision to stop crypto fundraising, stop terrorist financing by way of crypto fundraising. And what we had seen is a pivot to allow for crypto to be more actively used in the laundering space. There is one more point, actually, Mike, if I may, one point specifically on the subject of laundering that I would love to raise over here, and that is the subject of state-sponsored terrorism. Now, we had the sanctions actions that had been taken earlier this week by the Department of Justice and Treasury. But together with that, I believe that there should be a greater spotlight placed on the subject of crypto mining to facilitate state-sponsored terrorism. Now, Iran is a perfect example. It's been well documented that Iran is a state sponsor of Hamas, Hezbollah, and other terrorist organizations. What is also clear is that while sanctions apply to Iran, Iranian oil is very difficult to sell. However, the product of that oil, the burning of that oil, the electricity it generates, can be used to power mining rigs, which creates new crypto assets. Those crypto assets can sell at a premium in the open market because they have no history tied to them, with very little due diligence. So by way of them going back into circulation with minimal due diligence, what we find is that those assets can further be laundered and funneled into terrorist organizations. And that itself is a worrying vulnerability in sanctions controls. And I believe an area of crypto research, or an area of research that has to take place, both when it comes to fundraising and laundering of assets.
Well, you highlight the criticality of the travel rule in preventing the laundering of assets, sanctions evasion, et cetera. To date, what jurisdictions have adopted this guidance?
So not as many as we would like to see, and not as many as FATF would like to see. So our current research suggests that roughly 48% of jurisdictions that are members of FATF, of the FATF network, have brought crypto into scope for their AML CFT requirements. What that means, 48%. So less than half jurisdictions currently have in place AML CFT requirements that under which VASPs would have to comply. So that leaves a gaping hole, I believe, when it comes to regulatory oversight of crypto and virtual asset service providers. What we had seen through research done with a partner, CC Data, was that approximately 18% of VASPs with the largest trading volumes are operating without any regulatory oversight. So 48% of jurisdictions that are members of FATF, which takes us to about 110. Of those, only 50 have actually implemented or made provisions for the travel rule. And fewer than half of those have included language to cover counterparty VASP due diligence. So again, that hole that exists means that there's a distinct vulnerability in the virtual asset ecosystem, in that there are too many players that might be operating without any form of oversight, which means that overall industry standard due diligence, AML CFT controls, is lower than we would have liked. we understand, and I know FATF understand, you cannot implement a regulatory regime with a flick of a switch. But the Sunrise challenge, which is that when undertaking cross-border transfers with jurisdictions that either the originating jurisdiction does not have the travel rule in place, or the beneficiary jurisdiction does not have the travel rule in place, leads to a Sunrise challenge, meaning that institutions undertaking cross-border transfers are operating to different regulatory standards, and that has to be brought in. So we would prefer if that window is closed, and we see a more rapid implementation of regulatory regimes covering AML CFT.
And can you expand upon the impact on traditional financial institutions? So how can an effective travel rule program prevent traditional financial institutions from being the on-ramps and off-ramps for virtual assets used for illicit activities?
Yeah. So by on-ramps and off-ramps, you mean specifically the conversion of fiat to crypto and
Exactly.
the conversion of crypto to fiat. And this is so important. Like it or not, financial institutions have ended up as the gatekeepers to the traditional economy and the separation between the traditional economy and the crypto economy. And that's instrumental. We know that de-risking is not a strategy that would work. What's far more effective is understanding risks and asking the right questions to mitigate those risks in having VASPs and other crypto businesses as customers or providing services to them. So one fundamental element of the travel rule that gives the VASP a significant advantage over a VASP that is not compliant with the travel rule is it understands its ecosystem. It knows when a transfer is being made, who it's being made to, and likewise vice versa, where the transfer has come from at a named level. So that's important. It understands who its counterparts are and the regulatory status of its counterparts. And it also understands the intermediaries that might be handling those assets and the information that it shares. So it has a much better understanding of who it's doing business with than a VASP that is not compliant with the travel rule. So one of the questions that a financial institution should ask if it wishes to serve as a institution that provides services to a VASP but mitigates the risk of that VASP operating with or servicing terrorist organizations is to establish whether it's travel rule compliant and then obtain information on its counterpart profile, on the counterpart due diligence that it undertakes, on who it's transferring value with and where its beneficiaries or originators might be residing, because it understands the geographic risk associated with its customers and who its customers are doing business with. So coupling that information that a travel rule compliant VASP can obtain together with other information on the VASP, such as its footprint, its geographic risk covering customer risk, legal risk, and where it might be operating from, and what assets and services it's providing, for example, privacy coins. These risk factors could factor in to better understand the risks, the AML CFT risks that any particular institution can carry, and thereby minimizing risks that VASP might be not necessarily deliberately, but facilitating money laundering and terrorist financing.
You touched on earlier, common strategy leveraged by illicit financiers includes multiple layers of beneficial ownership to obfuscate funding sources. With that in mind, we talked a little bit about on-chain versus off-chain. Maybe you could provide a little bit of an overview on on-chain analytics, but also, focusing on how important is off-chain due diligence to preventing the conversion of fiat into virtual currency with respect to counter-terrorist financing.
Absolutely. So on the point of beneficial ownership, the travel rule would require that where in the past a transfer of value would be making its way to the equivalent, the analog of a numbered account, we now know the name of the account holder who operates the address, and that is important. Now, one of the areas that we have to be cognizant to is that on-chain analytics, i.e., analyzing that on-chain data for the purposes of identifying certain activities, whilst it is fundamental to determining risks that might be carried in any particular transfer and identifying source of funds, it's also so important for us to be able to understand the actor behind that activity. It's only when such context can be obtained that we would be able to understand whether that activity is in keeping with what that individual or business's nature of transfers would be, what their transactional activity would be, and why they would be undertaking such transfers. So without that off-chain context, the on-chain data is an incomplete picture. So obliged entities now would be required to remove the veil of this pseudonymity that's afforded to them because they only have address identifier rather than a name. That veil is removed, and we understand the parties behind any particular transfer. And in the event that a transfer is received or it's being made, and we see that it's going to or coming from a legal entity, we would be able to not just obtain additional identifying information, we would also be able to look further into, are they regulated? What's their profile? What's the ownership structure? And the effort being undertaken to better document ownership is going to be fundamental in ensuring that transparency is provided to them.
Appreciate that robust response. We have a little bit less than 5 minutes for today's webinar. So I just wanted to ask you, what have we not covered today that we should be thinking about, Neil?
Okay, so in my mind, the way that I see a decentralized vast network is much like you would imagine an air defense system, okay? Now, this air defense system has radar nodes that are active, and it scans this vast swathe of land to be able to understand if there are any hostile activities, if there's any unusual activity in the airspace. Now, every one of these radar nodes would be the equivalent of a VASP. It's every VASP's responsibility to ensure that it not just covers its own territory, but understand whether its neighboring nodes is also upholding a certain standard. That standard would have to be shared across the network. Any vulnerability would lead to the risk of a hostile being able to enter that airspace. It's on every individual VASP and every financial institution within the ecosystem to be able to uphold that standard. And that is fundamental because any vulnerability could compromise the industry. Now, what's important is for that standard to be upheld, it's important that regulation catches up, AML-CFT requirements are rolled out globally and consistently, and harmonization takes place sooner rather than later. The other point I would like to raise, and I know we are desperately short of time, but there is one further point, and that is the risks that could be carried by unregulated institutions. The first question that should be asked by a financial institution at the time of commencing a relationship with a crypto company, with a VASP, would be, what is their regulatory footprint? Who are they regulated, and what are they by, and what are they regulated to do? An unregulated institution could be essentially synonymous with a mixer, especially if it's operating from a jurisdiction that's uncooperative with your home jurisdiction. Getting that information is instrumental to being able to mitigate the risk of terrorist financing and ensure that that transparency that the blockchain affords us with is upheld.
And in conclusion, any other thoughts on how this will impact wider adoption of crypto in our final minute?
I think the question is one of data. With enough data to be able to make a risk-based decision as to who you're doing business with, I believe that we'll see room for the best players to be able to continue to participate.
Fantastic. Appreciate, and that risk-based approach popping up again today. It's been a theme in some of our other webinars in the past. Neil, thank you so much for your time and the insight. We look forward to having you back. That concludes our webinar today. If you'd like to learn more about some of the topics we covered, there's contact information for both risk and compliance at Dow Jones and Vastnet. Thank you for joining.
Thank you.